Doris, quiet. Doris, quiet. Doris, quiet.
So, howdy. Welcome to our Tax Connections webinar today. Very thankful for Tax Connections to host us to talk about a very important issue to most of you, well, to all of you piping in. Very thankful for Tax Connections. So Tax Connections, if you're not a member yet, I encourage you to go and join it. Now, my name is William Burns. I'm from Texas A&M University School of Law, and I've been invited by Tax Connections to moderate a debate on citizenship-based taxation. Most of y'all aren't lawyers, and you're impacted by the citizenship-based taxation because you're a U.S. national or U.S. person because maybe a green card, and you're living outside the United States, and maybe for 10 or 20 years it didn't impact you, and then all of a sudden this law called FATCA, F-A-T-C-A, got promulgated by our Congress, signed by the president, so it's a law, and then all this new information reporting seemed to come out of nowhere for you, and then the new information reporting didn't make a new rule that you had to file U.S. tax returns or pay U.S. tax. It just made the old rule come to the forefront of the discussion of your annual tax forms, tax filing in the local jurisdiction where you may have been living again for 10 years. There was a lot of additional costs. Banks stopped taking you as a customer or kicked you out of being a customer. You couldn't get a home mortgage, maybe a car loan. I mean, it impacted many U.S. expats in a variety of ways. So today, we're going to have two opposing views on citizenship-based taxation to talk about the policy of it. It's law, let's talk to your congressman. But I think this conversation today is about what kind of policy should the U.S. have, and then of course I'm sure people will go to their lobby groups and talk to their congresspersons about that. So we're going to start. We have Professor Edward Zelinsky, say Ed, who's a tax scholar in the United States. He's a professor at Cardozo Law School in New York City, and he's going to take the position that citizenship-based taxation is good policy. Then we're going to have John Richardson. He's a Canadian attorney who represents many dual nationals, U.S. Citizenships who are also Canadian, or just Canadian residents, or maybe they're long-term green card holders who are Canadian citizens. And so he's going to take the position that citizenship-based taxation is bad policy. So having said this, I know that many people on this webinar today have we had over 100 questions. So I've filtered through those questions, and I've chosen some of the more generalized questions where 10 or 12 people were really asking the same thing. And we're going to start with Ed, Professor Zelinsky, with the question, how can FATCA be moral when it is forced on a person that never lived and never worked in the United States?
Well, the simple answer is that we have a very strong philosophic tradition in the West, going back to Plato's Republic and the Bible. Political communities have the right to insist on support from the members of those communities. And American citizens who are holding on to their passports are holding to those passports for a reason. So if one wants to make an argument to me that perhaps FATCA is overstated, that it requires modification, I can accept that. But the basic notion that a country can request and require of its citizens that they support the political community of which they're a part, that strikes me as a very old and basic part of our political, moral, and philosophical traditions.
So, John, I think that's a perfect starting off question point for yourself. How can FATCA be, or citizenship-based taxation be moral for somebody who's never lived in the United States, who's never worked in the United States? What is your policy opinion on that?
Well, I think it's my view of it is, which is shared by many, is that it's not possible for it to be moral. And I would go actually a lot further, and I would say it is absolutely immoral. FATCA is the enforcement tool for the U.S. policy, which if you're inside the United States, you call citizenship-based taxation, which automatically leads to the the kind of language that Ed was using, okay, about supporting the government and this sort of stuff. But the reality is that citizenship-based taxation, American style, is something entirely different. What it is about the imposition of worldwide taxation according to U.S. specific tax rules on people who are tax residents of other countries and do not live in the United States. And I would add to that this is the full force of the Internal Revenue Code, which some days I view as being only peripherally related to taxation, but is really based, really imposes a massive punitive reporting regime where people are required to give more information to the U.S. government, the IRS, than they are even in their country of residence. Bottom line, and for this to apply to dual nationals or people who've never lived in the United States, is really to claim ownership over people who at best are only in a technical sense part of the U.S. community. They certainly don't see themselves that way. Many of these people who've been, identified in what I would call the FATCA roundup had no idea they were U.S. citizens. I mean, if somebody wants to take the position that, you're just going to look at a legal definition of citizenship that is posed only by one party, the United States, and that equates to morality, so be it. But I don't think that's moral. I think that's absolutely immoral.
Thank you. So now the second question is going to look at tax treaties and tax treaty policy. And we'll start with you this time, John, and then we'll move back to Ed. So the question is, if citizenship is a gap filler to assign domicile where none is otherwise assigned, shouldn't citizens who are actually domiciled in another country be treated only tax resident in that other country? Shouldn't the residence tiebreaker clause in the treaty be available to U.S. citizens who have immigrated or who are dual citizens with actual domicile in the foreign country? So the U.S. savings clause shouldn't apply to them.
Absolutely. Absolutely. There should be no savings clause to begin with, but if there were a savings clause, if that's to continue, certainly what's generally the Article 4 tax treaty tiebreaker rule should be part of the group of things that are exempt from the savings clause. The treaties are based on the principle, at least, and this is worldwide except for the United States, the tax resident should be defined in terms of the center of gravity of where somebody lives. There is no doubt, and incidentally, in Professor Ed's really brilliant paper that I would recommend to everybody in the Iowa Law Review, he himself suggests under the heading of dual residency, if I'm reading him correctly, the tax treaty tiebreakers ought to be available to U.S. citizens. I don't believe I'm misstating him, but if I am, I'm sure he'll let me know.
So, Ed, Professor Zelinsky, what is your retort on the tax treaty policy?
Let me talk more broadly, if I can, because I think lots of good issues are being raised, and I really enjoy having this kind of civil, professional discussion with folks who know what they're talking about. The question, for example, of accidental U.S. citizens. I think we all agree that accidental U.S. citizens should get relief. In fact, the statute 877A gives accidental U.S. citizens relief when they want to renounce their U.S. citizenship. I think it's very important to distinguish the implementing details of this or any other provision of the Internal Revenue Code from the fundamental policy. And I think you were right to have us focus in on the fundamental policy. The United States, I would say, has four fundamental policies. One is citizenship-based taxation. I think that makes sense both administratively and in terms of the political community. There also, under U.S. law, are very generous exemptions. Under Section 911, a U.S. Citizen who lives abroad can earn this year up to $106,000 and not report any income, even if they don't report income within the nation in which they live. There is then the credit for foreign taxes. And while the United States is criticized, I think, in overstated manner for not falling within the national consensus, our tax credit is well within the national consensus. And then I believe 877A permits expatriation from U.S. citizen on what are very favorable terms, particularly, for example, if you compare it with the Canadian deemed disposition system. So I think we need to distinguish two things. When Attorney Richardson talks about details, there are lots of details in the Internal Revenue Code with which I disagree, and there are many of them here. The question is, are those details an indicator that the fundamental policy is wrong, or are those details that ought to be fixed? He and I might actually agree on some fixes. The difference is I'm in favor of fixes. He wants to abolish citizenship-based taxation altogether. And I come back to the very fundamental point. Someone who lives abroad, who is holding on to U.S. citizenship, is doing that for a reason. They're making a statement.
May I respond to that?
Yes, please.
They're holding, in many cases, they're holding on to U.S. citizenship because they can't afford to get rid of it, plainly and simply. You know, if we talk about the Section 877A rules, which don't have anything to do really with the ongoing taxation, they do provide a favorable exit strategy for certain dual citizens, the ones who were born dual citizens, etc. But to get out on that basis, they still require, the 5 years of compliance. So on that point, I don't think it's certainly better. I mean, there's no country that treats its citizens worse who live abroad than the United States. And in the hierarchy, the people who are treated the worst are the ones who don't have any claim to dual citizenship at all. But when you compare, I with respect, I completely disagree with the suggestion that somehow the U.S. exit tax rules are more favorable than the Canadian ones. In fact, they impose taxation on more things than the Canadian ones do. And what the exit tax rules really are, and I want to tie this into something that you said earlier. I think that all of us would agree here that whether it's a Canadian departure tax, an Australian departure tax, or the US 877, say, exit tax rules, these are deemed dispositions, which means that what they really do is create, I'm going to use the phrase fake income. And by fake income, I mean income where there's no realization, but that is still included in income and people are still required to pay taxes on it. And with respect, I would make the very, I think, significant, important point that there is no possibility of using, these tax credits. There's no possibility of using the foreign earned income exclusion, for that kind of deemed income. And there are an awful lot of people who are holding U.S. citizenship because they simply cannot afford. They have absolutely no possibility of being able to pay these exit taxes that are imposed on them. Now, granted, there are Americans abroad who are proud Americans and are holding their citizenship, and they do identify as being Americans. But that is, I don't know what the percentage is, but there's a very significant percentage of people who are being held prisoner and captive to these policies and want nothing to do with American citizenship.
So if I can continue on.
Can I say, I'm enjoying this. I'm having trouble understanding this prison under 877A, and I'm having trouble understanding how 877A is tougher than the Canadian deemed disposition rules.
Sure, I'll give you some examples.
Let me give you some examples, and then I'll listen to your examples. There's an exclusion of the first $725,000 of unrealized income. Someone who has gain of under $725,000 does not pay any tax under 877A. Now, I don't know your perspective, but I would think that someone who's got income that accrued, unrealized income of $725,000 or more is someone of reasonable substance. In addition, even if they have income above the 725, it can be delayed. The tax can be delayed until there's an actual disposition. if they give appropriate credit, appropriate security to the IRS. So this notion that you can't easily give up U.S. citizenship is a proposition I think that is questionable.
Okay. When you talk about the 877A rules, you're talking about it solely in terms of the deemed disposition rules on property. That's one of four aspects to the rule. The one, and that is general, I would agree with you that, that $725,000 floor is very, very helpful. The problem in the world I live in, and in most first world democracies, is that people have pension plans, and they are generally pension plans that were accrued when people lived outside the United States. So let me give you an example here. Say a University of Toronto professor who's taught for 40 years or something and could easily have a pension. I mean, you would know this. Could easily have a pension of $1 million plus, or I don't know what the figure is. But the point is this: that the 877A rules, because it's a foreign pension, would require the full inclusion of the present value of that pension in income. And there is no deferral on that. Okay, there's no deferral on that one. There is no $700,000 de minimis thing or anything like that. So let's imagine that we take I'll work with a situation I know very well, a Canadian resident, say in the city of Toronto, where actually I live, who happens to own a house. He's owned the house, for 40 years or whatever, and he gets the house, who knows? I mean, it's like any major city. It could be worth significant amount of money. He's taught for 35 years at the University of Toronto. He has a pension that's worth a significant amount of money. Those two assets, leaving aside anything else, put him in covered expatriate category. If he decides to renounce U.S. citizenship, that's an automatic $1 million inclusion, assuming the pension's worth $1 million. That's a $1 million inclusion in his income with no money to pay it.
See, what's interesting is here you and I actually have some agreement. I happen to think that our treatment of dual citizens and dual residents pensions is wrong both domestically and internationally. And that's a long and complicated subject. So if you said to me that one way to cut through the problem of conflicting laws, international laws, problems with qualified plans, unfunded plans, that whole area, which is one where I think indeed there is a mess, if you said to me that you think it makes sense for someone who has pensions to be able to use the $725,000 exemption, I might be inclined to agree with you as part of an overall alteration of our international norms, as well as our U.S. domestic norms about pension laws. But that, to me, is a question of implementation. That's the point that I wanted to start out with. You can look at the status quo and say, this, like so much of the Internal Revenue Code, doesn't implement policies well. I would agree with that. But that doesn't mean the fundamental policy is wrong. It means that the statute should be changed. And the argument that pension funds should partake of some or all of the exclusion, that's potentially something that I think I could be persuaded to agree to in the context of an overall reformation. The fact of the matter is, even outside of the expatriation, our current treatment, both of treaties and in particular the way some of the European countries treat qualified U.S. plans, is deeply troubling. I think there's a strong argument that that area of the law needs to be fixed. That it doesn't convince me that citizenship taxation is therefore wrong.
So if I can move us on to, this is a really interesting issue, and I certainly agree that the retirement plans, having myself been an expatriate for many years overseas, retirement plans need to be fixed, however one fixes it. But recently, with our TCJA, we were both given the haircut tax, the transition tax, as well as the new GILTI, GILTI tax, which is a different way of looking at Subpart F. So I might as well throw in Subpart F and CFC tax also. I have heard personally, and it's certainly read it in the questions of, we know it's complicated, and for lay people, they would not be able to do their tax returns for GILTI, much less Subpart F, and the transition tax was you just couldn't do it. So, what do y'all think policy-wise about GILTI, transition tax, and Subpart F as it applies to the overseas expats. And we'll start with you, John.
Okay. Well, I think you know what I think. If one looks at the history of the subpart F, and I think it's important to touch on this for just a second here. In 1962, there's a fascinating research article on, what the intent of this was. And this was to go after certain types of income from multinational corporations. I've never seen historically a single reference to subpart F being designed to impact foreign-owned corporations that are owned by individuals, much less Americans abroad. Subpart F, a general principle, I think it was probably benign enough for people for a lot of years and not understood. I mean, many people in Canada and other countries who've had these small business corporations, I had no idea this stuff even existed. There's no question that they haven't been in compliance with it. But if they had, I think they would have objected very, very much to the notion that a Canadian-controlled private corporation, which is a standard way of, running business in Canada. And by the way, these things, going back to the pension thing, most people use Canadian-controlled private corporations as pensions, okay, as private pensions. I mean, what the U.S. views as a foreign corporation plays many different roles in different countries. I mean, the U.S., tax rules generally assume that, somebody's up to no good if they incorporate a corporation, but this is standard tax planning in other countries. As a general principle, I don't think that subpart F rules ought to be applied to individuals. But we move now to 2017. Let me give you an example. So, as you may or may not know, I mean, I've written a lot on, on this particular subject. It's a big problem. And you look at a professional corporation, a doctor in Canada, practices for 30 years, and he manages script and save and that, and he gets $3 million in retained earnings. And all of a sudden he's told, now when he's in retirement, that all of a sudden the rules are being changed to impose retroactive tax on something that was not taxable in all those years that it was earned. So this is retroactive tax. All right, and I mean, I agree there's an eight-year payout and all that sort of stuff, okay. A retroactive tax on all the retained earnings, the $3 million, without any realization event whatsoever. I got an email from the guy saying, well, so he's complied with this thing and he's had to put a mortgage on his house in retirement. It's not clear where he gets the income to fund this. To turn, this amount based on what's clearly a retroactive tax, in my view, in violation of various provisions of the U.S. tax treaties, to turn this over to the U.S. government. Now, I don't know. Now, by the way, I anticipate, well, this doesn't, convince me we shouldn't have citizenship-based taxation. I would like to make the point right now that I don't think there's anything wrong with citizenship-based taxation per se. I mean, I think it's okay. I think that probably Ed and I are in agreement that it needs to be adjusted considerably. But the problem is that this discussion is taking place in the context of what's really going on out there. And I'm going to use this language, and I stand by this language. That transition tax, as it applies to the individual shareholders of small businesses owned by Americans abroad, is nothing more and nothing less than a pure confiscation of their assets. So it's punishing them for their past, and of course the guilty, as you well know, leaving aside all the technicalities, sort of ends the concept of deferral whatsoever, just brings the stuff into current income, means that they're now deprived of the ability to use, what's standard sort of business and tax practice in other countries, to run their lives. Very bad, very bad.
So if I can just follow up, are you proposing a same country exception to the guilty rules? Would that make it okay for you?
I think, subject to the details, I think that probably would. Now, I think it might be a good moment to talk, for example, about Congressman Holding's proposed legislation on this, which doesn't in any way change the notion of citizenship-based taxation. What it does is it adds a new section to the Internal Revenue Code 911A and essentially expands the concept of the foreign earned income exclusion to include all different forms of income and include all foreign income. So my reading of that, I don't know what you think, but my reading of that, given that subpart F is clearly in the Internal Revenue Code income without the United States, outside the United States, I think that would solve that problem. But
So,
look,
Professor,
under no circumstances can these rules, from both substantive point of view and a compliance point of view, nobody even knows how to comply with this stuff, be imposed on the small businesses run by people outside the United States or in the United States.
so Professor Zelinsky, could you give us your policy?
Well, in part, I agree, and it's interesting that it turns out to be a little more consensus here than I would have expected. First of all, yes, U.S. tax law is much too complicated on all small businesses, domestic as well as foreign. And second of all, the provisions that we've started talking about, Subpart F and others, I think are among the most troubling of the provisions in this area of the law. And the reason for that is very simple, which is when Stanley Surrey and John Kennedy decided that Subpart F was the best they could get out of Congress, that they thought was going to be the law. And what has happened is that, of course, over the years, we've accumulated one regulatory regime over another, and these regimes have become incredibly complicated for people to understand. So if someone is trying to argue to me that U.S. tax law is too complicated for small businesses inside the United States and outside the United States, I agree. You then get to the fundamental question, which is, what should the response be? I think that if income has been previously taxed at a U.S. rate or higher in a foreign country, then it's a very sensible policy consistent with our views about tax credit that it shouldn't be taxed again. The problem, of course, is we have lots of folks out there who are taking a more, shall we say, extreme position than that, whose position is, I don't have to pay any tax anywhere. So the person who has paid taxes to a country with tax rates similar to the United States is someone who's in a very different position from someone whose position is, I don't have to pay any taxes anywhere. I also think that it's important when we talk about residence-based taxation that those who oppose residence-based taxation tell us what their alternative is. I, in fact, think many of the opponents, I can't speak for the attorney, I think many of the opponents want what we call statutory residence. That is residence based on number of days in the year as opposed to domicile. And I think it's very clear that that kind of system is very manipulable. So I think we need to look at at citizenship taxation, not in isolation, but in an imperfect world where there are balances and trade-offs, where it stands relative to what the alternative is. And I think those who say we're opposed to resident or to citizen-based taxation, I think have an obligation to tell us what their system would look like in practice if we were, in fact, to abolish citizenship-based taxation.
So
okay, how about the Canadian system or the Australian system or the UK system? We're to start off with 3 of all of the rest of the countries in the world that don't have citizenship taxation. I mean, this is not the norm. The U.S. is definitely, I'm not going to use the word outlier, okay, but it's kind of like this, all right? There are very few countries in the world, at least a minority of countries in the world, confer citizenship based on birth in the country. There are only 2 countries in the world, if you want to count Eritrea, although I don't really count it, okay? But there are 2 countries in the world that impose taxation based on citizenship. The United States is the only one that does both. The United States is the only country in the world that makes it impossible to effectively emigrate to another country system without renouncing U.S. citizenship. So, why don't we start with Canada, Australia, the UK, New Zealand, Germany, France? We'll start with those countries as alternatives to citizenship taxation, and we can go from there.
We can indeed go from there, because that, I think, is a very interesting set of issues you raise. Let's start, first of all, with this notion of U.S. exceptionalism. Sometimes exceptionalism is good, sometimes exceptionalism is bad. The United States is also an outlier when it comes to protecting religious freedom and freedom of speech, and I don't apologize for that exceptionalism either. So the mere fact that country A's policies are different from the policies of B, C, and D, that's not something that I necessarily find persuasive. And then you get to the question of whether I agree with your characterization of the tax systems of these other countries. You've read my article. In fact, many of these countries do assert domicile residence under circumstances that are very similar to U.S. citizenship taxation. I mean, ask Mr. Gaines Cooper whether his status as a non-resident, quote unquote, protected him from British taxes. Has the United States been more aggressive than these other countries about enforcing their rules? Yes. But to say that there's this sharp dichotomy between those systems and the US systems, I think overstates, or to put it bluntly, ignores the controlling case law in those countries.
Well, okay. First of all, for those listening, I highly recommend Ed's article. It is, honestly, I mean this sincerely, it's one of the best articles I've ever read in the area of tax residency in general. It's well laid out. It's just that I don't agree with a number of your conclusions, but that's not the point. Congratulations on a wonderful template for this discussion. The difference I think is this, okay? That first of all, citizenship is generally an immutable characteristic. It's something that you're born with, generally. The exceptions in the U.S. to be those who naturalize, they choose to be citizens, and those who choose to relinquish. Otherwise, it's something that they're basically stuck with. Now, let's look at Canada, which is one of the three countries that you used in your article. And I recall reading about those same individuals in some past iteration of my life, okay? But, the bottom line is this, that the people who object to this are in no way, shape, or form suggesting that it should be just a statutory form of residence. I mean, that idea has never even occurred to me. But the point is that there's a huge, huge difference between a test of ordinarily resident that Canada uses and citizenship. Ordinarily resident may overlap with domicile in certain circumstances, or it may not. What I'm not entirely clear on, and maybe you can help me with this, is what your definition of domicile is. I mean, every definition that I've seen, and I think this is what you mean, is sort of a permanent desire to return there. It's where you go home to die or something like that, I think. But, I recognize there are some countries that by statute use the word domicile. Interestingly, in the China tax reforms, I think they're using the word domicile. But there's no necessary connection between domicile and say, the Canadian test of ordinary residence. They're entirely different things conceptually, although they may overlap. And certainly, I know that you are proposing to use, if we start out from the principle that domicile is an appropriate determinant of tax residence, that citizenship is a proxy for domicile. I have a lot of trouble seeing that. Maybe you can help me with this, because citizenship is something where generally people have no choices conferred on them. Domicile, in other words, is objective. Domicile is clearly something that is subjective. So I just cannot see how one is a proxy for the other.
I'm having trouble with this notion that citizenship is an immutable characteristic. That's certainly not what U.S. law says. U.S. law allows people to surrender their citizenship. In fact, the United States is the only country in the history that has gone to war, as it did in 1812, to establish the principle that citizenship is not an immutable characteristic. And Canada was on the other and wrong side of that war. So this notion that citizenship is somehow immutable is a proposition that I think is hard to reconcile with what U.S. law really says. I think the more practical reality is that people are holding on to U.S. passports for a reason. And I think that at least some of the people objecting to U.S. tax want the best of both worlds. They want to hold on to the U.S. passport, but they don't want to support the United States. And I think earned income exclusion, someone who's entitled to credits, that's someone who pays little or no U.S. tax.
They pay a ton of compliance fees. As always, you raise a number of points at the same time. But if I can just veer away slightly, I'm going to ask you a question. Have you read Lucy Saylor's book, Under the Starry Flag?
Yes.
What do you think of the book?
So-so.
Okay, well, that's interesting. Okay, I actually think it's a very interesting book. But one of the points that she makes at the end of the chapter, where she talks about the whole 1868 Expatriation Act, is that she asked the question: was this intended to apply to Americans, or was it just intended to apply elsewhere? I mean, I agree with you that in a period of history when the U.S. was not the world power, Britain was the world power, and they were claiming British-born Americans as British citizens, and moving onto the ships and this sort of thing. Obviously, it was a big problem, and I think that everybody would agree. At least I hope. I think we would all agree that there should be a right of expatriation. But for American citizens today, expatriation is not necessarily that easy at all, for the reasons that I've given. It's hugely costly, from an exit tax point of view. I mean, I don't think that you or I would be particularly bothered by the $2,350, but the cost is prohibitive for a large number of people. It becomes exponentially prohibitive for family members. And I agree with you that expatriation is possible, but it's so difficult, all right, that I think it is more analogous to an immutable characteristic than making the decision, I want to move here and live here, or move there and live there. I mean, as it stands, the U.S. tax system effectively makes it impossible. Well, I'm not going to use the word impossible. Very, very difficult and costly to leave the United States, move to another country, become a tax resident of that other country, and comply with both systems, which have incompatible laws, etc. Now, I'm going to ask you a question here, if I may.
Can I ask you an example first? This person who doesn't want to pay $2,000 in order to expatriate, is this someone who's earning more or less than $106,000 in their native country, in the country in which they're living? I mean, I'm trying to understand who these people are who don't want to pay a couple of $1,000s to expatriate. If you're a low-income person, if you're a middle-income person, between 9/11 and the credit, you're not paying any U.S. tax. So who are these people who want to expatriate who can't afford the $2,000? Who are these people?
They're all over the place. You'll find them almost in every country, on every street corner. Let me ask you this. Is it true that in the United States, most people would have trouble putting $500 together if they needed it quickly?
The answer is yes. And those are people who don't pay U.S. taxes either. 50% of our people don't pay any income tax.
But expatriation is a question that's different from the amount of tax paid. I mean, there are people who, I think one of the things you're perhaps not seeing here, and I would invite you to consider this, is how brutally expensive and difficult the compliance is, leaving aside the question of, whether at the end of the day somebody owes any taxes or not. The problem, as I may have said earlier, is that when somebody moves outside the United States, their whole life, their income, their assets essentially become foreign. And once it becomes foreign, they're subject to special taxes, special reporting requirements, special penalties, sometimes fake income, all this sort of stuff. The point is that it is very, very difficult for them to be in compliance. It's awfully difficult to find people with the competence to do that kind of work at a price they can't afford. It is just not true that the average person, has this kind of extra money to comply with this regime. And I want to add to that the way it's administered, has made it a terrifying, absolutely terrifying experience and regime for people to live in. I mean, the only thing they can understand is the penalty provision. They never know if they're compliant. I mean, I invite you to do this experiment with one of your law school classes. Put together, get 5 people to imagine what it would be like to live in 5 different countries. Put together the scenario, what they're doing, how they're trying to, manage their retirement planning. Okay, and then go out to 5 different, tax professionals for each of them, and just see how much help you actually could get, and how many different answers you'd get, and how much of the discussion would focus on threats and penalties and that sort of stuff. It is not an easy thing. We can I think, agree. I don't really, I would prefer residence-based taxation. I don't like the citizenship-based taxation at all. But could we at least agree that the current system is completely indefensible?
No, I agree that the current system has some issues. So if you said to me that you and I could probably go through the compliance forms and you and I could probably agree on some simplifications that ought to be made, I think it's quite possible that would be a productive exercise. But I'm having trouble still understanding who these people are who are being oppressed by citizenship-based taxation. If they earn under $106,000, they don't owe any U.S. tax. So the next step is, well, they have to pay professionals. You and I have a different assessment of the professional help that's out there. Maybe it's because I work in Manhattan, but I have the sense that there are an awful lot of professionals in Manhattan who on the internet are doing an awful lot of work, doing good work at reasonable prices for U.S. citizens. So you and I have a different perception about that. But could we, in fact, see a reduction in the compliance costs? I mean, those forms, do they have some entries that you and I agree shouldn't be made? Or could we agree on a system where you fill out the form once a year and then you can every year just do a simple certification of no material change? Yes, you and I can agree on those kind of
I
simplifications.
think we probably could.
But
I think we
that's
probably
different from saying that fundamentally citizenship taxation is wrong.
Well, if I can ask y'all a question, which is following up exactly on this, Congress is the voice of democracy, is the voice of the people. Congress is aware of these issues. Congress, since the original 1913, passage of our current tax system, has toyed with and played with and changed the foreign income exclusion. Well, I think that was put in 1926. Congress has played with it, toyed with it. So this discussion comes up periodically, at least once every 20 years, sometimes every decade. So what gives? Why hasn't Congress addressed it? Is it because the American public in general prefers it this way? Or is there something else going on?
Before I answer that, I just wanted to add to what I was saying before. This 106,000 exemption, remember that it only applies to, business and salary income, right? And a lot of people are trying to survive with other kinds of benefits, et cetera. But I think the answer is simply this, that Congress does not care about Americans abroad in the least. They have no voice. And it's even worse than that. Not only do they not care, but they don't care that they don't care.
Well, I have trouble dealing with this thing called Congress, quote unquote. We have at any given time 535 members of Congress. They have staffs. We have lots of individuals. There are the whole spectrum of human behavior in the Congress of the United States. There's some very honorable people who care very much about things. There's some people in Congress who can only bring to mind Mark Twain's famous observation about no one's life, liberty, or property being safe when Congress meets. Why the Congress doesn't do any particular thing on any particular issue, I've given up explaining congressional behavior. One of the reasons that I'm enjoying this conversation is I'm frankly appalled by the degree of partisanship and divisiveness on both sides of the aisle in Washington. So if you want someone to make a brief for Congress, you've got to go to somebody other than me. Congress, I think, has been very responsive to, over time, to the problem of U.S. citizens who live abroad. The reality is, under our system, it can often take years and decades to get change to laws. If you don't like that, complain to James Madison. He designed the system this way, and he designed this system for a very specific reason.
Well, as a general principle, I think what you're saying in part is that it's hard to get a law passed. And as a general principle, I think that's a good thing. But, you've got this constituency of people out there. I don't know how many it actually is. I hear varying numbers, 9 million, 6 million, whatever. I mean, you've got a very significant number of people out there whose, issues are clearly are not being considered. Now, I'm going to give you a very practical example. We all know that, the tax reform debate was going on for a number of years, with the camp thing and the Senate Finance, was doing its hearings, et cetera, et cetera. And the largest number of submissions to both the House and Senator Hatch's the Senate Finance Committee on international tax came from Americans abroad. There was no response whatsoever, nothing. In fact, the response was, well, we're going to make it a lot worse with the guilty and the transition tax, which are unconscionable confiscation of assets, which are really, foreign source. So, the theory is one thing. The simple reality is that Americans abroad have had no success whatsoever, with the exception of, this new thing from Congressman Holding and even getting anybody to listen to them, much less think about the issue.
I don't know. I'm having trouble understanding this notion that Congress does not respond to citizens who live abroad. I'm not allowed to exclude the first $106,000 from my income.
So a couple of things here. First of all, that's a provision that I understand it was taken out, I think, for 2 years in 78 or, whatever. But that provision was never intended as a benefit for Americans abroad. It was intended as a benefit for American businesses trying to hire American citizens abroad. And that's a huge difference. Again, as valuable as that $106,000, the foreign earned income exclusion can be for a certain number of people, particularly in the countries where they don't pay income tax, like Saudi Arabia and stuff like that. As valuable as it can be, it does not reflect the reality of different income streams for most people abroad. The fact that it's there doesn't mean that anybody's paying attention to it. It doesn't mean that it was enacted with a view to benefiting Americans abroad, although it does somewhat. Look, the bottom line is people's lives are being destroyed. And if you're having trouble with this, what I suggest you do, honestly, is go over to Tax Connections and read the hundreds of comments on this. Okay. We're talking about the difference between theory, which I agree with you largely, in the in the sort of the theoretical construct of this stuff. But the problem is, like so many things, there's no correlation between the theory and the way this is impacting people's lives. It's got to go, or we're looking at the last generation of Americans abroad.
Explain to me why, and I did look at all of those comments. Explain to me why, again, these individuals are holding on to their U.S. passports, and explain to me why they can exclude $725,000 in gain on expatriation, but I have to pay tax on $1 of my capital gains. And then we say Congress is not listening or giving relief to non-resident citizens. I'm having trouble reconciling that with what I'm reading in the Internal Revenue Code. Looks to me like under 911 and 877A, they've done okay. Do you want them to do better? There may be an argument that certain provisions ought to be fixed. I, for example, agree with you that the whole provisions of, for lack of a better term, subpart F, personal holding companies, those provisions over time, Congress has simply layered like a coral reef and has made those things much too complicated. Could those be simplified and rationalized? Yes, I think they absolutely could. But to get to the core issue, to say that there's been no response to the problem of U.S. citizens living abroad, I think is to defy the fact that they, in fact, have some very favorable provisions. I think those provisions make sense. I think it makes sense that we say an American who has earned income under $106,000 should not have to pay U.S. tax, even if he or she doesn't pay a dime in foreign tax. I think it makes sense for us to be part of the U.S. International consensus on the foreign tax credit, which also prevents many U.S. citizens from paying tax. You and I have identified a number of other areas where I think reform makes sense, both foreign and domestic, such as the taxation of fringe benefits. You say compliance costs are high. Compliance costs are high for people under U.S. domestic law, too. Our systems are much cheaper. I have to disagree with you on that, because the one thing I do
most Americans, or a significant percentage of Americans, are they required to file these international information returns, 5471s, 3520s, all this stuff?
Pardon?
8938s,
right?
FBARs.
Right, and a United States citizen doesn't have to file complicated forms when you do your 1040, or if you have a little family foundation for a 990 PF. I mean, we've got lots of complicated forms domestically. If you say to me that United States tax compliance should be simplified, I would agree with you, but that's not a unique problem for our friends who live abroad.
Do you believe that U.S. citizens living abroad should be subject to exactly the same provisions of the Internal Revenue Code, exactly the same tax rules as a homeland American?
The answer is no, and they're not today, precisely for the reasons we've been talking about.
Well, this is where I would disagree. I think they are. They actually are. I mean, you keep going back to the foreign earned income exclusion. And I do agree with you that's important. I think it's valuable, but it has nothing to do with citizenship-based taxation per se. It's simply an island of territorial taxation in a sea of citizenship taxation. I mean, it helps a certain number of people, but it doesn't help them in the sense that they are tax residents of other countries. They are trying to manage their financial laws, financial planning. They are completely subject to the tax system of another country, yet they have this overlay of U.S. tax rules. Now, if one wants to keep citizenship taxation, and I am more committed to the view that the system needs reform than it is that citizenship-based taxation per se has to go. I mean, I'm not completely offended by the idea that somebody is taxed on citizenship, but it doesn't seem to me that it makes sense, or that it's fair, moral, or anything else, to essentially carve out one group of people, which is Americans abroad, whose lives are necessarily foreign and therefore necessarily subject to the most punitive provisions of the Internal Revenue Code, and impose all this stuff on them. I mean, what about just coming up with a different system of taxation? Congressman Holdings proposed legislation or something.
Help me out on the word punitive. How is it punitive for someone who's holding a U.S. passport to be expected to pay U.S. taxes on income that they earn above $106,000? How is it punitive to say that a U.S. citizen, a person abroad who has income on which they pay foreign income tax, is allowed to credit that against any income tax that is required by the source country? I'm looking for this punitive, this punishment.
Ed, think fake income. Okay, seriously. I think most of us would agree that the big problems here are not the things where there's a dollar for dollar credit, or going back again to this foreign earned income exclusion stuff. The real problems are the enlargement, okay, of areas where there's a deemed attribution of income without any realization event whatsoever. Now, let's take some. Leaving it in the range of normal everyday people here for a moment. What about the whole mutual fund issue? Treating these things as PFICs. So the way these things are taxed is, it is very punitively, because, as you know, on the gain, what they do is they attribute the gain. They deem income over the number of years of the holding period, even though there was no income. And then, if that isn't bad enough, they impose an interest charge on the deferral of fake income, which is compounded daily. That's an area that's a problem. Okay. And the foreign tax credit rules, at least in terms of the Internal Revenue Code, and if you look at the way the forms have been designed by the IRS, do not allow foreign tax credit on the part of that, okay, that would be the interest charge on deferral. So you got that problem. And now, maybe that's not what it's supposed to do in theory, but I got to tell you, that's the reality of what these people live with. Now, let's go to the small business corporation, which is a normal way of living for people. I mean, there is no way to characterize things but the transition tax and GILTI in subpart F as fake income. Meaning, again, all right, simply income deemed to somebody without a realization event where they have to pay tax on this stuff without having received it. These are not areas where you get, the availability of tax credits or the foreign earned income exclusion, or the exit tax. Again, it's a fictitious tax event. These are the problem areas.
Is it a factitious tax event when the Canadian deemed disposition system does something similar?
Yes.
So you're equally critical of the Canadian system.
I am critical of exit taxes as a general principle. Yes. Okay. But the fundamental difference between the US 877A rules and Canadian deemed disposition rules reflect the fact that the US uses citizenship taxation versus Canada's residence-based taxation. And the problem with the 877A rules really is that, as far as I can see, they overwhelmingly impact Americans abroad, or, well, maybe green card holders, at least as far as citizens. They overwhelmingly impact Americans abroad, and they are exit taxes that are imposed on non-U.S. assets that were earned when somebody was not a resident of the United States. I'm going to go back to the pension thing, which is, unbelievable, because if you look at the 877A rules, a Canadian pension, this whatever it is, $1 million pension, I think I used before, is an automatic income inclusion. But if it were a U.S. professor, then it would be an eligible pension, and they would essentially be able to hold on to the pension. Okay? I mean, it seems to me there's a clear example of punishing somebody for a life outside the United States. The American would hold the pension. That is, the American resident, the professor at, say, Berkeley. The professor at the University of Toronto basically, confiscates the pension. And this is fake income, all right, because there's no realization of it. Tell me this: where does somebody get the money to pay the tax on that pension? And no, there's no deferral on that type of thing.
You have to help me understand the question. This is someone who's got a pension.
Okay, let's take a simple example. We'll go back to Toronto, where I can look out the window. So we have a University of Toronto professor who's a U.S. citizen who's lived in Canada at least during the period that he's a University of Toronto professor. So he's reaching retirement, and he, has a pension worth, let's say, $1 million, which is not large for 35 years, this sort of thing. Let's imagine that he has a house, and these two things, put him into covered expatriate territory. So he wants to renounce U.S. citizenship. So what happens is the full $1 million is included in his income, right? It's a deemed inclusion. He doesn't have any money. He has no way to pay the tax. Now, I want to compare that, because part of the theme here is the punitive taxation of Americans abroad. I want to compare that to what if we had a situation like this. Okay, we have, and I've worked with people like this. Okay, we have people who have taught in American colleges and universities. They have built up significant pensions. They, they say they want to move back to Canada or somewhere, and they decide that they want to renounce citizenship. Now, that person, because it's a U.S.-based pension, is eligible. It can treat as an eligible pension, will not be forced to do the full income inclusion on the thing. This is a clear example of just punishing people for living outside the United States. Plus, it's on a Canadian asset.
Let me help out. First of all, this person kept his U.S. passport for those 30 years for a reason. Second of all, you and I agree that it would make sense in that situation for the same $725,000 exclusion to apply to this individual. And that's a reform that I would approve of. But this is an individual who for 30 years kept his American passport for a reason. What was the reason he kept his American passport?
I think people have varying reasons. I think that probably there was no reason whatsoever. For it. Because it's only since FATCA the the enforcement of this citizenship taxation regime that people have had any real reason to think about citizenship issues. I spent a good part of my life thinking about citizenship issues from a legal point of view, and this is the first time I remember this last 5-7 years where anybody's had any interest in this stuff at all. I don't think there was any reason for it at all. They may have been born in the United States. They just moved to Canada. They became Canadian citizens. They had an awareness of U.S. citizenship. No reason whatsoever to get rid of it, though.
Hey, gentlemen, we've reached the top of our hour, and I think it would be helpful if each of at this stage, because we're at 2:00, if each of y'all gave a summation of what you would do in a perfect world, or nothing, because the world is perfect. And we can start with you, Professor, and we give a 3-5-minute summation, and then we can invite Tax Connections to join us and talk a little bit about Tax Connections.
Well, first of all, I want to thank both of you gentlemen, as well as thanking Tax Connections. I've enjoyed the last hour, and I hope it was useful. I think it indicates an important lesson, which is that when discussion occurs on a civil and professional basis, you actually find out that sometimes there's more commonality than when you thought out. We seem to have an agreement that the basic answer to the question, is citizenship taxation in theory acceptable? The answer is we seem to agree at this point that in theory it is. The question is, how should it be implemented, and in what ways should it be implemented? I happen to think that some of the problems that have been raised here today are legitimate concerns. I also believe that the exceptions that we're talking about are more important than my colleague does. I think the fact of the matter is that an awful lot of Americans abroad hold on to their passports because between the credit and the exemption, they don't owe any U.S. tax. And that is a sensible policy. We're told repeatedly the people who are being hurt here are people of low income. Low income people don't pay U.S. tax. Could we simplify the way that they have to comply? Yes, there are lots of ways U.S. tax law could be improved. We could talk for hours about the ways I think U.S. tax law could be improved, both for U.S. citizens and for who live domestically, and for U.S. citizens who live abroad. But to the fundamental question here, does it make sense for the American polity to say, you're holding on to a U.S. passport, you're identifying with the American polity, you're getting you are a member of that community. We expect you to pay U.S. tax when you're not paying tax to a foreign country that assesses source income. That, I think, is a reasonable policy, not a punitive policy. I think it's a reasonable policy. Is it a perfect policy? No, but we don't live in a perfect world.
And John, your summation, what's a perfect world going to look like when you are made president?
Well, I don't know what a perfect world looks like, but I certainly am deeply committed to the view that the current system of what the U.S. calls citizenship-based taxation, which is actually a policy of imposing worldwide taxation according to U.S. tax rules on people who are tax residents of other countries with no connection to the United States. Well, that includes dual citizens who've been gone for years, people who don't even know they're U.S. citizens. In some cases, they don't even speak English, is absolutely, positively, fundamentally wrong. And it really needs to be changed. And I think it's an embarrassment for the United States. Now, I would agree that is a fundamentally different question from whether citizenship-based taxation is ever acceptable. I don't like it under any set of circumstances, but I would concede that citizenship-based taxation per se, as I do believe constitutional, and I do believe could be changed around so that it could be tolerable. I think that, for example, let's look at the only other country that uses citizenship-based taxation, the African country of Eritrea. Now, what they do is they impose an excise tax, as I understand it, sort of a percentage of the tax that you pay in another country. That would be a better way of doing it, or a passport fee or something like that. As it stands right now, what the United States is doing is so much worse than what Eritrea does that it's almost an insult to compare Eritrea and the United States in this context. That is an insult to Eritrea, and that's why, my own view is there's only one country, that really has citizenship-based taxation in the sense that we're talking about it. These problems are very real, regardless of what anybody thinks about the theory. I think that Ed makes a number of excellent points from a theoretical level. I just don't think that they reflect the reality of the way a lot of people are impacted by this. I'm not okay with citizenship-based taxation, but sure, I'm willing to accept it and go along with it, I suppose. But what has to happen is, Ed would say, well, it's the implementation that needs to be changed. Okay, if by implementation he means a completely different type of regime that doesn't essentially, treat everything that an American abroad has as foreign and therefore, makes it subject to penalties. I think that it has to avoid that type of problem. But I want to thank you, and I certainly want to thank Ed for his willingness to participate in this discussion. I think it's been great, and I want to thank Tax Connections, of course. But I really would like to see this as perhaps the beginning of some additional discussions on this. And this would be a great project for one of your law school classes. I think get them thinking about it. This is the effect that this is having on people's lives is just indescribable. But thanks for showing up today.
Both there are many issues we didn't touch on today, and I'm sure that the audience will welcome round two.
Let's have round two.
We did not talk about the F-bar, and we didn't talk. So I'll leave that for Tax Connections and y'all to set up round two in the coming weeks. Meanwhile, I encourage all the listeners today and those who watch the video later to download Ed's article, Professor Zelinsky's article, as well as to review the blog of John, and to which is excellent. He's also an author of mine, so I'm biased by his writing, and I encourage y'all to look at some of that literature that he's putting out there, because I think it's very helpful for those, especially laypersons who aren't tax people, on some practicalities of compliance that y'all are grappling with overseas. So having said this, I welcome Tax Connections to rejoin us and to explain about Tax Connections. And is somebody there from Tax Connections now? Thank you, everybody.
Thank you.
Look forward to next round two. Look forward to
All
round
right.
Very good, gentlemen.
Okay. Thanks.
Bye-bye.